Hi, my name's Chris Perez, and if you're here, you know what I do professionally. I am in the commercial real estate lending industry. I'm going to start doing a series of calling them quick hits of the deals that we look on a regular basis. Obviously, I would do this on my computer. The goal of this is for any real estate investors out there that want to, they have commercial deals or are looking to be in the business. I want to be able to explain to you what these deals look like. If I can help you get deals closed, or if you have a commercial deal or investment property, give us a shot. But quick hits is really a way to learn about the deals and why they make sense, why they might not. So without further ado, quick hits. I'm going to talk to you about a deal that I'm working on that I got in this morning. Tell you why it's a deal, why it's not a deal. We're going to do this unscripted, and here's how it goes. So I have a loan submission in. I'll look into turn on my computer. And here's what I got. I got a mixed-use property that is, I got 3 borrowers. The main borrower has credit in the 700s. I have 2 borrowers, minor borrowers, partners that are going to be in the mid-600s. Local property here in Pennsylvania. The property type is mixed use, which I love mixed use. A lot of lenders don't like mixed use. And what we have today is we have a neat one. We have a cash flowing restaurant and 4 apartments. So we have a residential component, which makes it mixed use with a restaurant. One red flag right off the bat, when you look at this from the lender's perspective, is that restaurants are extremely difficult property types to finance. And the reason is the failure rate. 90% of all restaurants fail within the first year. So they are very high risk when it comes to lenders. The fact that this is a mixed use with apartments, I love that fact because the apartments now bring in stabilized income. If the restaurant isn't doing well, you're always going to have those 4 renters hopefully carrying the mortgage payment. So far so good. I got a borrower in the 700s. We have a mixed use property purchase. Now the purchase price on this particular one, this is a pretty big deal. It looks like $2.8 million. So we got a nice loan. Obviously, every lender wants to do this. If you're in the mortgage business, these are the loans that you want. If you want to become a commercial broker, the deal on this, something like this, you're talking about 1% or 2% on the fees. So this could be anywhere from a $20,000 to a $40,000 more fee deal if you're a mortgage broker. Now, here's where the issues start to arise besides restaurant. Desired LTV is 90%. That means they want to put down 10% on the property and business. Now, most commercial LTVs are in the 75% range. Now, what that means is you're going to need 25% down on a typical commercial property, office building, strip mall, retail. It's normally 75 LTVs. It means you have to come with a hefty 25% down. Mixed use, you sometimes may be able to go to 80% LTV, 90% LTV, 10% down. The only options for a 90% LTV type deal, there's 2 ways to do these. SBA, Small Business Administration, they can go as high as 90% LTV. And they also consider the business component as well. So they're not only assigning a value to the property and the business. So this would be an SBA loan. On the real estate side, there are lenders that do 90% CLTV. And that just means that the borrower can bring 10% down. And the seller, for the remaining 15%, would be able to hold a private mortgage. So you do sometimes have 90% CLTV. So now here's where we get, so we have a ultra high LTV request on a $2.8 million loan. You have a couple borrowers in the mid 6s. And here is where things get a little bit wonky. Cash liquidity on hand is $45,000. We're talking about a $2.8 million deal. Liquidity that can be dedicated to the transaction is about $100,000. Even at 10% down on a $2.8 million purchase, even at 10%, you're going to need $280,000 down. And that's just the down money. No lender is going to let you borrow to zero, and you're going to have closing costs in there. Closing costs, you're going to have reserves and need the capital on hand. So for a $2.8 million deal, you're going to need at least maybe 300. You're going to need at least almost 300,000 plus dollars on hand. So we're coming up short on this particular deal, a couple 100,000, and maybe more when you factor in closing costs in reserves. So on this particular deal, we're not going to say it's a no. What we're going to do is we're going to go back to our borrower and we're going to educate them and let them know that, hey, on deals like this, even if we went to that 90% LTV, on a $2.8 million deal, you're talking $280,000 plus closing costs and cash reserves. Do you have more money to contribute to the deal? Maybe you need to go out and find an investor to help you get this deal done, and then we can relook at it. Right now, this deal as it is a no-go. We're not showing enough cash on hand to do it, but we're going to get right back to that borrower and see what we can do. So that's today's session quick hit on a mixed juice restaurant, and I'll see you on the next one.